Most traders think that the concept of resistance is just the exact mirror image of support. But if that were true, then bear markets wouldn't fall faster than bull markets climb. But they do. There are some similarities between support and resistance, but there's also some subtle differences too. That's what we're going to explore in this video. I'm also going to show you how we can take resistance and connect it with the concept of supply.
As any market starts to fall, traders who short at the top will reach a point where they want to take some profits. As they do, it puts a temporary floor underneath the price action. Bullish traders looking to buy the dip now see this as their opportunity to get long in the market in the hope of selling much higher. If the market fails to rally, these traders get trapped into losing long positions as the market falls through the previous swing low. They are now on the losing side, and it's this group of traders who will help the market form an area of resistance. This is why as the market starts to trend down, we want to mark the swing lows or the valleys in the trend. What's really important to understand is that in a falling market, bulls on the wrong side just want to get out of the market. Now, when you consider that most traders don't even use a stop loss, all they can do is hope that the market rallies back. They will very quickly turn into sellers if the market starts to trade back up to their entry point so that they can exit with a small loss or even at break even. This is how resistance is formed in a downtrend. Your analysis will really come alive when you then add in the concept of supply together with points of resistance. What this does is turn our resistance point into an area over the swing low point in the valleys of the downtrend. The reason we do this is exactly the same as with the areas of demand in an uptrend. It's because not everyone trades at the same time or price. Finally, many new traders tend to make the mistake of thinking resistance is just the exact opposite of support. This isn't quite true. Generally, you'll find that in all markets, bearish trends tend to fall faster than bullish trends tend to climb. Therefore, because losing longs panic when they're on the wrong side, we can judge how bearish the market really is just by looking at how deep the pullback into resistance really is. If experienced traders who are on the wrong side think the market is very bearish, they won't wait for the market to pull back so they can break even on their losing trades. They'll front run the market and accept a loss instead. We can see this in how the price action barely touches the resistance, or in some cases doesn't even get there at all. So to conclude, that's how we define resistance in a downtrend, connect it with supply in the market, and use our understanding of how traders panic to judge the momentum in the move.